Hey there, and welcome. I'm glad you're here. Chances are you've already heard whispers about one of the biggest scandals in cryptocurrency history, FTX's sudden collapse. But what if I told you the real story is even more shocking than anyone imagined? In this video, we're diving into the $8 billion fraud hidden right in the company's source code. Today, we're going to break down exactly how this once top-tier crypto exchange hid a staggering $8 billion fraud right inside its own source code. This wasn't just a mistake, it was a deliberate and carefully planned scheme. Stick around till the end because we've uncovered a shocking detail about the people behind this that you absolutely need to hear. Let's dive in. In this video, we'll walk you through how FTX grew so big, how they managed to hide the fraud for so long, and the role their sister company, Alameda Research, played in this entire mess. We'll also explain how regulators missed all the red flags and what this means for the future of the cryptocurrency industry. Plus, don't miss the surprise twist at the end. Before we get started, be sure to hit that like button and subscribe for more in-depth investigations into the biggest tech and finance stories. Let's start with some background. FTX was founded in 2019 by Sam Bankman-Fried and quickly rose to prominence. It wasn't just another exchange, it became one of the top 3 crypto exchanges globally. At its peak, FTX had over 1 million users and handled billions of dollars in transactions every single day. Bankman-Fried, often referred to as SBF, was seen as the golden boy of crypto, regularly giving interviews and speeches about how he was making crypto safer and more accessible for everyone. FTX built a reputation on trust, claiming to provide a safe, transparent, and highly liquid platform for traders. It attracted some of the biggest names in finance, including institutional investors like BlackRock, and even high-profile endorsements from celebrities. Everything seemed perfect, but beneath the surface, things were far from normal. The beginning of the end came in November 2022, when FTX suddenly filed for bankruptcy. The company's balance sheets revealed an $8 billion hole. The once mighty FTX had collapsed almost overnight. So how did it all unravel so quickly? Now here's where things get really interesting. Investigators discovered that FTX's downfall was the result of a deliberate fraud built into its very foundation, the source code itself. It turns out that FTX had secretly embedded a backdoor into its code. This backdoor allowed executives at FTX to transfer funds between the exchange and its sister company, Alameda Research, without anyone noticing. Normally, such large transfers would be flagged for review, both internally and by regulators, but FTX had programmed the system to bypass these checks. This allowed the company to move billions of dollars without triggering any alarms, effectively siphoning off customer funds to cover Alameda's risky bets. To explain it in simpler terms, imagine your bank had a secret code that allowed the CEO to move money from your account to their personal account without anyone knowing. That's essentially what FTX did here, except it wasn't just a few dollars, it was billions. But how did they manage to pull this off without being caught sooner? The complexity of FTX's trading platform played a significant role. The platform's architecture was highly sophisticated, making it difficult for outside auditors and regulators to understand what was really going on under the hood. FTX's public-facing systems appeared clean and functional, but in the background, the code had been designed to facilitate this fraud. Even more mind-blowing is that the backdoor transactions didn't leave the usual digital footprints, meaning auditors and regulators wouldn't have spotted anything unusual unless they knew exactly where to look. What do you think about this hidden fraud within FTX's code? Let me know your thoughts in the comments below. Should crypto exchanges be held to the same scrutiny as banks? We've still got more to uncover, including how Alameda Research was involved and the aftermath of this whole ordeal. And don't forget, we have a shocking final twist coming up that will leave you speechless. Stay tuned. Now let's talk about Alameda Research. Alameda was FTX's sister company and played a pivotal role in this entire scandal. While FTX was the public-facing crypto exchange, Alameda operated more like a hedge fund. Its purpose? To engage in high-risk, high-reward cryptocurrency trading. Alameda's ties to FTX were close, perhaps too close. Both companies were founded by Sam Bankman-Fried, and reports suggest that Alameda had special access to FTX's customer funds. Whenever Alameda made a bad trade or faced liquidity issues, FTX would step in to cover their losses using customer money. These weren't just small loans, we're talking billions of dollars being funneled back and forth between the two entities. FTX's fraudulent source code allowed these transactions to happen behind the scenes. This meant that every time Alameda made a risky bet that didn't pay off, FTX would use customer deposits to keep the hedge fund afloat. The customers, of course, had no idea that their funds were being used in such a reckless manner. It gets worse. Because of this special relationship between FTX and Alameda could make trades with more favorable terms on the FTX platform than other users. In essence, Alameda had an unfair advantage, which created an uneven playing field in the marketplace. This level of interconnectedness between the two companies raised serious conflict of interest issues, all of which were hidden from public view. Now the big question, how did regulators miss such a massive fraud? After all, FTX was a multi-billion-dollar company with investments from major firms. Surely someone would have noticed that something wasn't adding up, right? Well, this is where things get tricky. The crypto industry has long operated in a regulatory gray area. While traditional financial institutions are heavily regulated, crypto exchanges like FTX have been able to operate with much less oversight. FTX, in particular, was based in the Bahamas, where regulatory scrutiny was even lighter than in the United States or Europe. FTX took full advantage of this lax regulatory environment. The company's operations were complex, its financial dealings opaque, and its leadership well-versed in navigating regulatory loopholes. Even seasoned auditors had a hard time keeping up with the intricate nature of FTX's financial arrangements. But it wasn't just regulatory loopholes that allowed this fraud to go unnoticed. FTX actively courted the trust of regulators and the public by presenting itself as a responsible player in the crypto space. Bankman-Fried even testified before Congress, advocating for clearer regulations around cryptocurrencies. This created an image of legitimacy that masked the fraud happening behind closed doors. What's even more shocking is that FTX had a team of auditors, but because the fraud was hidden within the company's own source code, they didn't catch it. Regulators have since acknowledged that the FTX case has highlighted serious gaps in the oversight of cryptocurrency exchanges, and there are calls for a complete overhaul of how these platforms are monitored in the future. So what happens now? The collapse of FTX has sent shockwaves through the entire cryptocurrency industry. Several lawsuits have been filed against FTX and its executives, and Sam Bankman-Fried is facing charges for fraud, conspiracy, and money laundering. Prosecutors are aiming to recover the missing billions, but many believe it could take years to untangle the web of transactions between FTX, Alameda, and other entities. The impact of this scandal goes beyond FTX. The entire crypto market took a hit after FTX's collapse, with billions of dollars wiped off the value of cryptocurrencies like Bitcoin and Ethereum. Investors are now more cautious, and many are questioning whether the promise of decentralization and freedom in crypto is worth the risks. We're also likely to see stricter regulations coming soon. The US government and other global regulators are already drafting new laws to prevent a similar situation from happening again. These could include more rigorous financial reporting requirements for crypto companies, audits of source codes, and stricter penalties for companies that misuse customer funds. For the crypto industry, FTX's downfall could be a turning point, pushing it toward greater accountability and transparency. But for now, the damage has been done, and it will take years for the industry to rebuild the trust it has lost. And here's the shocking twist I promised you at the beginning. Investigators have uncovered evidence that Sam Bankman-Fried wasn't just covering up losses. He may have had a grander scheme in mind. There are rumors that SBF and his team were working on a secret plan to control the entire cryptocurrency market. Using the money funneled from FTX, they allegedly aimed to manipulate the prices of certain cryptocurrencies to profit from market swings. This isn't just speculation. Whistleblowers have come forward claiming that SBF had detailed strategies on how to take over smaller crypto exchanges, and eventually, he hoped to influence the value of major cryptocurrencies like Bitcoin and Ethereum. If this is true, it would be one of the most ambitious and dangerous financial schemes ever attempted in the crypto world. While these allegations are still being investigated, they add another layer of complexity to an already jaw-dropping scandal. Whether or not this plan could have succeeded, we may never know. But what's clear is that Sam Bankman-Fried and his team were willing to take extraordinary risks, and in the end, it led to their downfall. That wraps up our deep dive into how FTX hid an $8 billion fraud inside its source code. The shocking revelations about Sam Bankman-Fried's secret ambitions have sent shockwaves through the crypto community. What do you think? Will crypto survive this scandal? Let us know your thoughts in the comments. And before you go, don't forget to like, subscribe, and hit the notification bell so you don't miss more investigative content like this. Thanks for watching, and we'll see you in the next one.